So I want to go to Scott Shellady, Carol Roth back with us on the impact on energy prices because they'd already been going up, right, guys? And now they're, sort of bouncing around certain levels here. But a lot of people have been looking at 47, 48 days in a row, Carol, of rising gas prices up 30% already this year. Where do you see this going?
Well, first, I feel like the ship is a metaphor for all of us trying to fit back into our jeans after COVID.
Careful, young lady.
Yeah, it's been a rough time, but this is wild. If you think back, Neil, to like the third week of April of last year, you couldn't give oil away. There was no place to put it. Now we're in a situation where maybe things are stuck. At the end of the day, oil's a weird one. I do think that overall, the bigger issue for oil's pricing is going to be what's happening with the vaccine rollout in Europe. How quickly can they get things on track? Global travel, getting things back to normal. I think this is, sort of that blip on the radar and isn't as important as what's happening more, from a more dynamic point of view globally with COVID.
Scott, we have been seeing, a host of commodities, oil and gas included, rising. And I know inflation is still not a problem, but the trend could be. What do you think of the trend?
I think the reopening of the economy or the reflation of the economy, I think that's not a trend. I think that's binary, and we'll get through it, and we'll get back on the other side to hopefully some normalcy. But, with this distribution problem that we're having here, our economy, when you shut it off, it goes off like the gym lights after practice on Friday. Right? When you come in Saturday morning for practice and you flip the switch, it takes a while to get those lights to relight, right? But demand, you can flip a switch and it's on overnight too. So we have a problem logistically about getting those planes, trains, trucks, and ships in the right spots to meet up with the demand that we have right now. That's the disconnect. And that's going to take between 6 and 12 months. And then you've got Mr. Magoo captaining that ship through the Suez Canal that's going to throw another wrench into things. And so that's going to take some time, too. So this is just going to add, misery to pain, but it will get through it because we're going to get back at some point in time to the way things were pre-pandemic as far as logistics.
Which might be okay. That might be okay. A little bit of growth is okay. So, Carol, I'm wondering if you're Jerome Powell and you're seeing this uptick in inflation, certainly not anything like the 70s, but it looks like he is going to sit back and let this happen for a while, even if he falls behind the proverbial curve. What do you think of that?
I say, thank goodness that I'm not Jerome Powell. Listen, economists aren't very good at making estimates, and we all know that they're not very good at communicating things to the markets either, as we've seen from Powell and Yellen the last couple of times around. So I think that at some point the horse is going to leave the proverbial barn, and they're going to have to play catch up. And I think that that's what the bond market's been signaling. Now, whether that happens in the next 3 months, in the next 6 months, in the next 12 to 18 months, that's what we're trying to sort out, and that's the trade that everybody's trying to reposition for. But at some point, it seems like they're going to be behind the 8 ball, and they feel like they can bring this in for a soft landing, but I think it's going to be bumpier than they expect.
All right, we will see. Guys, thank you both very, very much.